Hello, I'm Maura Millis, and I'm Associate Director of the Northeast Region of American Friends of the Hebrew University. I'm delighted to welcome you to a very timely program. Will 2022 be a year of major tax law changes? First, I want to thank all of our generous friends who are here with us today, including members of AFHU's Einstein Visionary Society, which recognizes donors who have provided for the future of the Hebrew University through their legacy gifts. I also want to especially recognize PNC Bank, sponsor of our Einstein Visionary Society, for their most generous and ongoing support of American Friends of the Hebrew University. The Hebrew University of Jerusalem is addressing the most critical challenges of our times, from medical advances which are healing the world, to environmental science combating climate change, and agricultural advances which are helping feed the world, archaeological discoveries to better understand our past and our future, to exciting innovations in high tech which are having a global impact. It is the support from friends like you which make this all possible. Thank you. I'm delighted to introduce today's speaker, Neal Myerberg, a principal at Myerberg Philanthropic Advisors and a special consultant to AFHU. We're so fortunate to have someone with such deep experience. Neal has worked as an Iras attorney with a focus on estate and gift taxation. Today, Neal will share some critical updates, which will be helpful as you consider your year-end planning and charitable giving. Today, we invite you to send your questions during the presentation through the Q&A feature, and Neal will address them during the program. Neal, I turn the stage to you.
Thank you, Maura. Let me invite people to look at the outline. Welcome, everybody. So happy to know you're aboard and on a subject matter which every day changes. As you may know, if you keep track of the daily reports out of Washington and out of the Congress, you know that what was proposed for yesterday changes today and will change again tomorrow. And here it is October, and we thought by this point we would have a pretty good handle on what was going to happen in 2022 and what we should do between now and the end of this year, but we don't. But what we can do is we can talk today about what we think we know, what is pretty evident, and we can talk about it from the beginning, which is when the president in the early part of this year proposed a number of tax law changes, many of which would have great implications to many of us, particularly individual taxpayers. And that became the discussion piece for a long time until recently when the Congress took a role. So let's take a look at where we are in terms of the tax law change. Let's remind ourselves of some things what we have been keeping track of. There was a campaign for the presidency which talked about a substantial amount of changes to the tax code, which would change rates for high-income households and corporations and raise them higher. And it would also have a great impact, as you probably are aware, and maybe this affects this conversation more than anything else, on how to pass assets to heirs. In other words, how are we going to do estate planning in light of what will be substantial proposed changes? And so the tax code sweeping discussions coming out of the administration in the beginning talked about rates and about capital gains and about estate taxes. And it became a conversation piece for those of us trying to figure out what to do before the year moved on. Among the things that were discussed, as you can see here, is raising the individual rate to 39.6 from 37. Now, it doesn't impact everybody, but it impacts a number of people, particularly since they want to extend the portion of the Social Security tax to earnings above $400,000, not the present 137.7, which means that maybe you're not going to pay a lot more income tax if your rate isn't going to expand, but you're going to pay a lot more in Social Security's tax, which is the subtle tax we don't see often, but really adds up on our 1040s to create our final tax discussion. And interestingly, and maybe most difficult for people to do around planning, is the idea has been proposed to raise the capital gain rate to almost double, from 20% to almost 40% for taxpayers with income over $1 million. Okay, so you may say, well, it doesn't really include me. I don't have $1 million in income. Well, we don't know whether the ultimate bill that's passed might have a stepping provision that says it's 39.6 for income over $1 million. What will the cap gain rate for if your income is over 750? What will your cap gain rate be if your income is over $500,000, over $400,000? We don't know, but it seems to be a goal to make capital gains a substantial resource for the tax to be collected to pay for programs. Now, whether or not the cap gains become the dominant way to pay for programs is what we're trying to figure out, because in fact, if they don't get an increase in the multiple rate for corporations, and in this case for individuals, then the revenue is going to come from somewhere. And capital gains are ripe to be taxed and ripe to be used against people, because in fact, capital gains would be taxing things at higher rates when they're realized. What happens if they're not realized is the conversation we have to have. So right now, here are the two scenarios that we're thinking about, have been proposed at the administration level. With regard to estate taxes, this is really much more difficult for individuals to get their heads around. And that would be overhauling taxes around wealth transfers. Wealth transfers are gifts during lifetime and bequests and estates. But here's a critical piece, and you've read about this, and this is bothersome, worrisome, the idea of the step up in basis. Step up in basis rules, which have been around for a long time, say that if you inherit something from another owner of an asset, that date of death value becomes your basis as the heir, so that when you sell the asset upon receipt, you pay a tax on gain based upon the value at date of death of the person who left it to you. That's always been the case. It made it very easy. So the tax was really not assessed in the first estate. And if you didn't sell it in your second estate, you didn't have any tax either until then. But if you did sell it, you sold it based upon date of death value. So if someone had Apple stock at $15 and the date of death is worth $400, $385 in gain would not be taxed, and you would make your sale based upon $400,000. Well, there is now discussion, it's not a surprise, that maybe that should not be the law. Maybe it should be that there'll be no step up basis. Since we haven't taxed that capital gain, why don't we just tax it when you sell it upon receipt of the inheritance at the basis of the individual who left it to you? Gifts have always been taxed at the basis of the individual who gave it to you. Why wouldn't things you receive by estates be taxed without a step up? And that's the conversation. And lastly, we have this still provision that says 11.7 million of an estate's assets in 2021, or double that for spouses, is still the exempt amount for transfers free of estate and gift taxes. But the proposal is to reduce that to 3.5 million in transfers and 1 million in lifetime gifts, and to have a base rate in the estate tax and gift tax rules that anything in excess of 3.5 million would be taxed at 40%. That's a very significant change from 11.7 to 3.5, or in the case of couples, 23.4 to essentially 3.5 per person. So that's a bit of a frightening thing to contend with respect to planning an estate, when you see the difficulty in having assets taxed at much higher levels at a much lower base. So these are the things proposed and still proposed by the administration. Let's look now at what the House of Representatives is saying, because there is some indication in the Congress, even in the Congress, the Democratic side of the Congress, that they're not going to fall in lockstep with some of these provisions. So when I built this chart to try to show you the comparison side by side, not recognizing, not admitting that we know either one is going to be the one that gets ultimately enacted. But you remember again, you're going to raise the rates on the Biden side up to 39.6, extend the portion of the Social Security tax earnings over a certain amount. The House says we'll raise it to 49.6 for single filings making above $400,000, and for joint filers above 450. So what they're doing is they're saying we'll make this rate for individuals and filers at a certain threshold. Again, it's a pretty high rate. Will that be the rate that we think will ultimately pass? Most people don't believe that's going to be the case, but you have to see it. You have to see it. And also the House says there'll be a 3% surcharge on modified AGI above 5 million, or for trusts only above $100,000. So Again, do you use a trust? Are you doing things in your own ownership? So complicated, but we have to pay attention to it because we're not really sure what will be enacted, whether it be the Biden piece or what is now in the House of Representatives or a combination of compromises. Cap gain rate. Biden suggesting 39.6 against 20% now. The House plans are more generous for the taxpayer. They propose raising the cap gain rate to 25%, not the 39.6 as you can see here, but applying a new 3% surcharge on 5 million plus, include the net investment income tax, which is under current law, and the top federal cap gain rate based upon this number, the new base rate, and the surcharge for certain taxpayers, and a 3.8 net investment income tax could take us to 31.8. 31.8 is still high. In fact, as I point out here, it's the highest federal cap gain rate since the 70s. And if you think about the ones of you who live in states like California, and New York, and New Jersey, and other states where the top cap gain rate would also apply, it could take you with federal and state taxes, if you use the tax plan of the House, to cap gain rates on average nearly 37%. Pretty expensive, but it's a revenue measure, and it's taxing something that you have acquired, accumulated, and succeeded in investing well that would otherwise have been taxed much more gently than ordinary income, and getting it close to taxes at ordinary income rates for certain individuals. So you can see the difference. The Biden side, the House side. Where's the compromise? And number three, this is kind of important to start paying attention to. I said in the earlier slide, we have 11.7 million in exempt estate for 2021. If it goes to 3.5 million for 2022, and a million lifetime gifts is going to be radically different. The tax rate may be 40% or higher, but let's look at what I put in the asterisk here. Nothing happened. If nothing was done now, in 2026, which is not too far along from now, the statutory exemption will be 5.6 million with a top rate of 55%. That's in the current law. Forgetting what I'm put on the screen, if nothing happened in 2026, things change radically. So you want to take advantage of what is available in 22, 3, 4, and 5. Not to say that law won't change before 2026, but if nothing happened, you can see there will be a considerable reduction in the exempt amount. And on the House side, they would reduce the estate tax exemption in 2022 from 17.1 million plus inflation to $6,020,000 and change the unified estate tax credit. Something's going to happen between what Biden has looked for and what the House is saying to effectively reduce the exempt amount in the estates. Does that mean one should rush to do as much estate planning as possible in the next month and 3 quarters, October, November, December, almost the next quarter? Well, the answer is probably yes. The answer is probably yes. Will there be a clawback so that, in fact, if it's enacted in 2022 in January, that they'll reach back into 21? No one knows, but it's probably unlikely. So you might want to consider what should you do still in 2021 in terms of gift and estate planning, particularly to take advantage of what will probably be historically the highest exempt amount per person for estate and gift taxes. So in effect, be careful, watch the exemption the House is proposing, watch the exemption that the Biden administration is proposing. And if this happens, the House will effectively eliminate grantor trusts by saying with a grantor trust, no matter how you put it together, we're going to include the whole value of the grantor trust in the donor's estate. Lots of people, many of you on this phone probably have created grantor trusts and other kinds of vehicles which take advantage of present values to lock in future values and exempt them from the estate. So let's be careful about that. Proposed change chart number 1. Proposed change chart number 2. This is more about, again, estate planning. I'm repeating in the top what I said in the prior page, just so you can see this on the screen for comparison about the exempt amount Biden proposes, the exempt amount that the Congress is proposing. But look at Biden's step up in basis position. He would eliminate the step up in basis on assets transferred after lifetime. So as we said before, I don't have to repeat it. Your basis would be the basis of the person who's passed away, his or her basis. House says we're not going to eliminate the step up in basis. I mean, it's completely opposite to what the Biden administration said. So, you know, most of us would rather be here, but that doesn't mean that's where we're going to be, or there might be some compromise saying there is some step up in basis, but probably not 100% step up in basis. The Biden administration says we will tax capital gains to a surviving spouse on the sale of the property she inherits without a step up. But she doesn't, but we won't tax it initially. We'll only tax it upon that sale without a step up. What the House is saying is if there's a tax, if any, it'll be from step up. So if a spouse sells the assets after lifetime, assets she may have been spousal owner of, or assets she's receiving otherwise, it will be taxed with a step up in basis. And lastly, from the charitable giving perspective, for those individuals, and I'm going to speak about it in a while, who might be using charitable remainder trusts now or in 2022 to deal with the stretch IRA provisions, the elimination of the 10-year rule, there is some provision in the Biden Act that say that there may be some tax on the non-charitable portion of the charitable remainder trust when it's created, because some of it's an annuity and some of it is not. That's never been the case. But if that happens, that creates problems in a planning perspective, whereas on the House side, there'll be no front-end capital gain tax on contribution. The only thing the House is saying is we're going to alter the valuation rules. We're going to eliminate, the House says, valuation discounts for entities holding non-business assets like LLCs or LLCs that are invested purely in publicly traded stocks, for example. Things to be concerned about. These are side-by-side charts that talk broadly and generally about what is going on, knowing that, and again, I have to repeat this, we don't know exactly what's going to happen. What could happen is that it'll happen all of a sudden. It'll just result in a compromise discussion between the House and the administration. And next thing you know, there'll be a bill. And at that point, we'll have a sense of what it will be. It doesn't mean the Senate will take it. It doesn't mean it will pass, but it'll be a pretty good idea of what the planning aspects are. So in effect, what I've shown you in these slides is what could well happen. How about planning ideas? Well, you might want to apply, as I said before, some of the 11.7 million in 2021, because we don't think there'll be a clawback if the credit's reduced. So take advantage of it if you can, if you want to. You can do it directly. You can do it through various vehicles, including what is called a charitable lead trust. Number two, if in fact there's going to be a higher marginal rate in 22, if you got bonus opportunities or deferred income that you could wait for or you could take, if in fact we're going to have substantially higher marginal rates, you might want to grab more income in 2021. Number three, for capital gains purposes, if there's going to be a substantial increase in cap gain rates, harvest them if you can in 21. You can take them and pay tax at the low rate now just to make cash. You can give some of those shares to charity, as you know, or to your donor advised fund, or to create an endowment fund at the university, make an outright gift, fund the foundation, a gift annuity, charitable remainder trust. And if you do that, those shares, except for the question of the gift annuity, will be exempt from capital gains and moved at full value. So you might want to do that. And a lot of people are thinking seriously about funding donor advised funds, funding their gifts at AFAGU and other charities, funding scholarship funds, funding things they've been thinking about doing, but doing it now to get some shares out of their portfolio now that have lots of capital gain in it. As you know, contribution value is deductible based upon the type of the gift, and gain will not be recognized or taxed except under the mathematical formulas for gift annuities or charitable remainder trusts. And by the way, as Mara may have said early on, we welcome your questions throughout in the Q&A box, and we'll deal with them throughout if you have anything you want to ask. There are some business that has been done before in tax planning, just that you can remember it. Number one, this year, if you don't itemize, you don't have substantial enough itemized deductions, but you make charitable gifts. If you're an individual, you can take it above the line, $300 for the year, couple can take $600. It's like an itemized deduction without itemizing. You can't do it even if you get $3,000. You only can deduct this kind. These are the numbers that you're limited to, but they do reduce your AGI, so they're worth knowing about. Number two, and this is again important for those of you doing your substantial tax planning, this is the last year you're going to be able to make charitable gifts of cash and deduct them up to 100% of your adjusted gross income. Next year, we go back to 60%. We could go back to 50%, which was the original rule. But right now, if you want to make substantial gifts of cash and front end them in 2021 before the law changes, you can deduct them up to 100% of adjusted gross income. That can make a great deal of difference in your financial and tax planning. Whatever you give them to, as long as they're cash, you'll get the measurable deduction and you can deduct them at that full value. I was talking to someone the other day who is accelerating, he plans on accelerating his AGI by taking $1 million of AGI, at least they're taking $1 million from an IRA or some multiple of $1 million from an IRA, which will create adjusted gross income because it comes out as ordinary income, and giving to charity a sum equal to that amount in order to avoid at least the tax by deducting the full value of the charitable contributions up to 100% of AGI. It's possible, it's doable. You talk to your accountant about it.
Neal, I have a question.
Yeah, sure.
Came in. Will you discuss conversion from traditional IRAs to Roth IRAs?
Well, Roth IRAs are still valuable and useful because they don't result in tax when you start taking them out. If you have them, they're desirable, but if you're going to want to create them, of course, you know that you create them by rolling an existing over to that Roth, you have to pay tax on the distribution. It may work itself mathematically, but Roth IRAs still have a great deal of utility in personal financial planning. The inherited IRA, which is what I'm talking about right here, this box to the bottom left, is the one that's subject to the elimination for many taxpayers of the stretch rule. Those of you know that many of you planned the idea that when your IRAs were going to pass on to the next generation of family, who were the people who were going to take it, children, for example, were going to take it and pay tax on it and take distributions on it based upon their life expectancy. And mathematics were good. They take a small percentage out each year, what their then RMD requirements. They only pay tax on that amount, and they would have a lifetime worth of income at low tax cost, but ample rewards. Now the rules have changed. 10 years. Must take it out fully within 10 years, which means it's going to be much more tax and much more money taken out much quicker. We need to find strategies for that. I'm going to show you one in just a moment. As I point out on the bottom box right, the Charitable Remainder Trust may offer a solution to this 10-year requirement. I'm going to show you. What about standard deduction this year? We know you can take it. I was just repeating what I said before. This chart for you, and by the way, you may have been told by Mara, let's remind ourselves, this outline is available to you. If you'll contact AFHU after the seminar, the final screen on this will show you where to write. You can get this outline and have it to use and even show it to your professional advisors if you want to. What about the IRA 10-year distribution rules? That's what this is going to talk about now. Have to take it within 10 years. And I'm saying in bullet point number 2, those who wish to leave retirement plan assets to children, a charitable remainder trust might be considered. A charitable remainder trust is an irrevocable trust that's created to receive assets and to pay a fixed amount each year, each quarter of each year, to one or more individual beneficiaries for life or lives. If you can get past the 10-year rule and want to have it done for their lifetimes, the charitable remainder trust might be desirable because they will get annual income at a stated rate. The payments will be taxed them, and sometimes favorably, because some of them may be tax preferred. It's a quantity, it's a type of trust that ought to be explored because it's being used often by people as a way of dealing with the 10-year rule. Exceptions to the stretch IRA withdrawal. The only way you can be excluded from it would be if you're the surviving spouse of the original owner, surviving spouse of the original owner. B, if you're the minor child of the original owner, not a grandchild, a minor child, which means the owner of the Iras child would have to be somewhat under the age of 18. The 10-year term applies once the child reaches majority 18. So this is really unlikely to occur, but if it does occur, the initial amount can be withdrawn under the stretch provisions, and once a person becomes 18, the 10-year term applies. Number 3, if the beneficiary is less than 10 years younger than the original owner, then the stretch provision still applies. And lastly, although I haven't defined it here, and you can always look for the definition, an individual who is going to receive the IRA as an inherited IRA who is defined as disabled or chronically ill will also be able to take the distributions over life expectancy and not under the 10-year rule. These are the provisions. So when you look at this concept, you realize nevertheless that taking spouse out of the equation, most everyone else is going to be subject to the elimination of the 10-year stretch provision. If you want to deal with it, I'm not going to read this slide to you. You'll have this if you ask for it. A CRT fixes a rate, charitable remain trust fixes a rate. You can see bottom box middle. There's no income taxes charged to the estate of the owner. That would be the IRA owner. And a portion of the assets will be exempt from federal estate taxes. The trust can run for up to 20 years or the lifetimes of individuals. Most trusts will run for lifetimes because you're planning that most people who receive it are going to live more than 20 years. And so this is something you need to get a calculation for. You can get a calculation, I'm sure, from your professional advisors, your lawyer, your accountant, your financial planner. You can get a calculation of this without obligation, without even personal information from AFHU, just to see whether it makes sense. I've just finished a transaction where a couple have separate but substantial IRAs. They have one child, an adult child, who has some disability. They're concerned about protecting that child from the disability and the assets being received, but also to get out of this dilemma of the 10-year rule. So they have established through their lawyer a charitable remainder trust now, unfunded, but the text and structure is there. The provisions say that at the end of the lifetime of the second to die, both IRAs then will be transferred to this charitable remainder trust. They will fix a rate based upon the legal rate allowed at that time, and the child will receive income payable at fixed rate throughout his lifetime if he survives them. They did it because they had no other option they could think about, because otherwise they weren't going to leave the assets directly to the child. Number 2, they didn't want the child to be subject to the 10-year rule because it could be spent out and gone. Number 3, they wanted to leave the end result to charity because the child would have no heirs. This is what they decided to do. More and more people are thinking about this. I think that this is a challenge for planners, a challenge for you who are thinking about how to pass your IRAs. I would suggest that you put some time into this. This is not going to be changed by these tax law discussions, but this is something that's really troublesome for lots of planners, financial estate planners. Now let's think about something that you do know about and will continue in 2021 and 2022, and that is what we call the Ira Charity Rollover. Many of you have done it. Many of you didn't do it in 2020. Remember, in 2020, we didn't have to take RMDs in 2020, and I suspect most of us didn't if we didn't desperately need the money, and many people do. But if we didn't take RMDs in 2020, then you probably didn't use the Ira Charity Rollover qualified charitable distributions in 2020 because you were going to tend to use the RMD money to do that, but we didn't have any RMD money. So there may have been plenty of reasons not to take those distributions in 2020. Now here it is 2021. Here's what lots of people did with regard to 2020. I did it myself. In January or February 2021, some people like myself said, okay, I didn't make my 2020 contributions. I'm going to do some qualified distribution, qualified charitable distributions, QCDs, Ira Charity Rollover, early in 2021 to pay my 2020 gifts. And now in October, November, December of 2021, I'll take additional QCDs to pay my 2021 gifts, knowing that I'm making double payments this year, but I'm going to exempt them from tax because they won't exceed the $100,000 limitation for qualified transfers from Ira Charity Rollovers. So you may have done it, you may have not, but in any event, it's a very good planning because we're going to take RMDs this year. Many of you on this call are charitable. Many of you make your regular gifts. Many of you do any number of things. If you're going to make outright gifts to charity, then think about doing it under the RMD transfers of some of the RMD under the Ira Charity Rollover. So you want to send the information to your Ira administrator to do it and be certain they understand that they're going to do it for 2021. You have plenty of time to do it, but I wouldn't go do even December. Even though you take your RMDs, you can still exempt a lot of them by taking this kind of distribution. Question now arises. And again, it's all tied into tax in a way. What is it about fixed income? And what is it that's going on that causes us some concern? Well, we do know this. Interest rates are likely going to rise in 2022. The Fed said so. There's a whole different model now. There's inflation, whether we like it to believe it or not, and whether it will sort of peter away or whether it won't. It's still there and it's still something you can grapple with. And one of the ways you grapple with inflation is you raise interest rates. It levels things off. But when you raise interest rates, you know what happened? Mortgage rates go up, credit card debt interest goes up, any number of things goes up, and they go up higher than the interest rates you may get on your money market or on your CDs or on even your treasuries. So if they will go up, but we think not substantially. This is interesting because the Fed has said it's going to stop its asset purchase plan, buying lots of treasuries, for example, shoring up the economy, because we will probably just do it with interest rates. And since we're now talking October the 4th, the announcement is going to come in November. So in thinking about what's going to happen, you might want to lock in some interest rate programs in this year that will come and follow you for your lifetime, if possible. I'm speaking about annuities, particularly charitable gift annuities, in order to say, okay, interest rates may go up in 22, but that doesn't mean they're going to stay that way. And I don't know if they're going to impact annuity rates. Annuity rates have walked to a different drummer. So maybe we should be thinking about some gifting to create more income in 2022 for 2020 and 2021. Number 3, the IRS discount rate, very low. That's the rate the IRS tells us that assets will earn. And since it's very low, it impacts annuity rates. And it impacts annuity rates in a significant way. Number 1, it makes annuity rates a bit lower for younger people, people under 70. And number 2, it gives us a larger portion of tax-free income every year in our annuities. So it's good and it's not so good. So it is what it is right now. And it's likely that it'll be 1% at least through the end of the year. That's what we see as the potential range. And lastly, taking risks with cash is difficult now. I mean, many of us may say, well, the market's doing good. Maybe we should put more cash in an S&P index fund, for example. Maybe we should take some more risk with our cash. I don't know if that's a good call. I mean, I was always taught that you took 120 and subtract your age, and that number suggested all that you could. The difference between those two numbers is all you should be at risk. So if you're 80 and you subtract it from 100 or 120, you know that that's a small amount that you want to be at risk. And what does risk mean? Risk is anything other than cash or cash equivalents or insured obligations. So we must be careful. So I'm proposing that taking risk with cash is probably not a great idea as we get closer into 2022.
Neal, there's a question about capital gains tax that came in earlier.
Yes.
If you want to take a moment to explain why, will it apply to sales after the bill was introduced, not in 2022, regarding new capital gains tax rate?
So the question, I think, is what clawback will be retroactive? Is that the question, Mara?
After the bill was introduced, not in 2022. Is it true the new capital gains tax rate will apply to sales after the bill was introduced, not 2022? That's the question.
No, it's not. It's not the introduction. It's the enactment.
Yeah.
So sure, there's a possibility. I think it's unlikely that the bill, if passed, will retroactively go back to transactions that occurred in 2021 that you've already done. I just don't think that's likely. I don't think the House is going to do that. I don't think the president intended to do that. But the moment it's enacted, for example, if it's enacted in early 2022, let's say April, that doesn't mean it won't be retroactive to January 1, 2022. But we just don't know. So if you've got gains to take and you're concerned about retroactivity, I would take those gains in 21 because the rates going to be lower. And I think that's the better planning if you can do it in your financial planning. Your financial planning is not only tax planning, it's income, it's wealth accumulation, it's building a nest egg, it's not outliving your assets. So I think that's the best course of action. Anything else, Mara?
There's a question about tax ramifications, switching from a traditional to a Roth 401ks as it relates to potential changes in the tax environment.
I don't think there's any change in that. It depends on your marginal rate. If you're going to roll over or try to move current IRA or 401k assets to a Roth, you're going to be realizing for tax purposes the money going out of the traditional IRA to the Roth. Now, if you did it in 21, your marginal rate is going to be lower than it is in 22. And once you create the Roth becomes tax exempt. The Roth can grow tax-free. It can pay you tax-free. You can do some math on this. The question is, if you take money out of a 401k or an IRA or any other kind of qualified plan, and you're going to move it into a Roth and pay the tax on the distribution to you that goes in the Roth, does it make sense in a financial planning context to do it? And it's all unique to individuals. So I suggest that even the Roths are really good. If you're thinking about doing a Roth with existing retirement plan money, see what the tax cost will be and see whether the cost benefit analysis is good for you.
I have another question that came in. Why fund a donor advised fund prior to tax rate increasing? Is there more benefit after rates increase or no effect?
Well, if you're funding a donor advised fund with securities, with appreciated securities, it probably won't matter much because what you're doing is you're taking securities at their full value into your DAF. You're paying no tax on the gain. We assume there'll be no tax on gains still for gifts to charity. Whether you do it in 21 or 22, it doesn't really matter. What's more important is if you're going to sell some of those securities, that's really the issue. Whether or not donor advised funds, by the way, for those of you who have them or been thinking about them, have been under scrutiny for a while, particularly since it's a huge industry. And the question is whether or not there should be some compelling arguments for making further and quicker distributions from DAFs. Will there in fact be an exempt amount in a DAF for gifts of stock so you don't have to recognize gain? A lot of things being discussed, but to answer that question directly, I don't think it makes any difference whether you do DAF now or in 22, as long as you're intending to move appreciated securities to it. You get your deduction and you avoid tax on the gain. So gift annuity, just for reminding ourselves of this conversation, is good. It's been so valuable for so many people over the past 25 to 30 years. It allows you to support charity in the future, but to take care of yourself at present. And since we in New York, those of you in California and a handful of other states, which are regulated states, protect you as an annuitant, you want to be certain you're dealing with a charity that is subject to that regulation. If you make a gift annuity with American Friends of the Hebrew University, you in fact are being subjected to either New York or California law, which is set up in such a way to assure protection for annuitants. So I'm showing here, somebody makes a gift of cash to securities, gets an annuity, gets income for life, and a substantial portion of the income is payable to you tax-free. I'll show you a few examples anyway, because just so you can be refreshed about it. But these are the kind of things that once you understand the concept, you're going to want to have a customized calculation to be certain it works for you. The compelling reasons are A, is the rate something you can be happy with for the rest of your lifetime? B, can you use the income tax charitable deduction? Some people can't, some people don't itemize. And C, are you happy with the fact that so much of your payments received is tax-free? For example, things you should be alert to. I did a calculation today for somebody whose birthday is in December. And she said, well, in December, I'll be 71. I wrote back to her and said, no, you've been 71 since the period of time within 6 months of December. So people don't know that, but you are your age to your nearest birthday. So right now, when you're deciding upon a gift annuity, if you are, think about what you're nearer to. The age you think you are, your next birthday, that changes the rate. The older you are, the higher the rate. Number two, and this is a more difficult concept to understand, and someone asked me about this the other day, who's thinking about doing a gift annuity for himself and for his sister. He's saying, if I do a gift annuity and she's younger, is the rate based upon her age, is the rate her individual rate? The answer is no. The rate is lower. So if her rate is 6.5 and his rate is 7.1, and they do a 2-life gift annuity, the rate will be lower than 6.5 because the IRS says that a joint and survivor gift annuity will run longer together than would run for each individually. That's based upon actuarial mathematics. So the rate will be lower than the rate for the younger person. The annuity continues to be paid if you outlive the tables, although we calculate based upon life expectancy tables. Your goal is to outlive the tables. We're encouraging that because you continue to be paid. Joint and survivor, the payments continue for the second person till the end of his or her lifetime. And lastly, you may be using stocks, and people do use highly appreciated securities to do gift annuities. Some of the payment you receive each year will have some capital gain tax in it, hopefully at lower rates, some ordinary income, and some tax-free income. Most people do gift annuities with cash because you don't have capital gain income, you have substantially tax-free income, and some ordinary income.
Neil, 2 questions that came in if you want to take a break.
Sure.
If one needs to update estate planning documents, as they were drafted 20 years ago and include a revocable grantor trust, would you recommend waiting to draft new documents for a new estate plan until after the current proposed tax changes are finalized?
That's a fascinating question. I think about that all the time.
The documents do not include exemption trusts that are apparently not a good idea under the current law.
Yeah, but I think that's true. I'm wondering, the question, it's a valuable question. If you have an estate plan that's been done by a very good estate planner, I'm sure in this case, and there have been some trusts created and some planning ideas that may be affected by these changes, I think you rest on it right now. I think if that's the case, you can do a codicil, if you will. You can do a rewrite. You can get rid of the things that don't work and keep the things that do. But to change it now based upon a bunch of what ifs, where you have a pretty polished estate plan, probably not necessary. And so therefore, I would suggest that you keep in touch with your estate planner. I think about estate planners like I think about physicians. You see them once a year, either virtually or face-to-face. You go over all this stuff. If you do a will 20 years ago, hopefully you're getting it reviewed from time to time. Hopefully your planner is contacting you and saying to you, hey, things are changing now. Here's what we should think about. But I think you need to pay special attention to this. I don't see clawbacks, by the way.
There's another question.
Yes.
Is there a proposal being considered that sets limits on IRA at 10 million, which represents a combination of both traditional and Roth IRAs, and that amount, any amount in excess of 10 million?
Yes.
Must come out.
Yes.
Yeah, the rates it's going to be taxed at.
There's a whole body of discussion now about these, what they call super IRAs. You've been reading about certain very wealthy people who early on created IRAs and moved some of their company stock into the IRAs and their company stock came in at almost zero basis. And all that stock has grown, and maybe there's been an IPO, there's been a number of things going on. And those IRAs went from virtually zero to 5, 10, 15, $20 million. The government doesn't like them. We've read about this. There's going to be some penalty discussion. There's going to be some substantial tax. There's going to be a number of things. I don't know what to tell people who are lucky enough to have those kind of IRAs, but you can be pretty certain that there's going to be some action even beyond what I've had on the screen here, because that's a separate item. That's not part of a consolidated tax act. That's a special item that the government is taking a look at now to try to get some taxes in scenarios which are, in the government's word, egregious. So yes, the point is well asked. We'll have to watch it. Let me show you more. Of course, we'll get questions to me when they come in from you, but let me look at these for a second for you. I'm not going to spend a lot of time on these tables. I just want you to see what things look like. Here's a charitable gift annuity. Donor age 70, life expectancy 15.9, male or female, says to AFHU, I want to give you $10,000 to create my first gift annuity. Tell me what happens. And you look at the tables for somebody age 70, and the annuity's value is 5.1%. The purchase price of $10,000. The tax deduction, if you itemize, is 31% of the amount you've contributed based upon life expectancy. If you're a marginal rate taxpayer in federal and state, you'll save some taxes to reduce your costs. If you take your reduced costs and divide it into your annuity, your effective rate is 5.5%, and nearly 85% of your annuity amount is paid to you tax-free for nearly 16 years, which is your life expectancy. In effect, if you want to gross up, your return is greater because 85% of it is tax-free. So if you do the math, you want to say, what would this have to be in a rate if it were not tax-free to show me the same return? And it's pretty substantial. So this is why I say that the rate is higher than prevailing interest rates for individuals. Will there be a higher rate coming out in the next several years in other kinds of instruments? Maybe. Hasn't happened for a good while. But some people say, okay, I'll take some money risk with some of my savings. I also want to put some money away to assure my retirement. This is one strategy to do it. As a donor age 70 or donor age 75, you can see that the life expectancy gets lower and the rate gets higher. The tax-free portion is even higher because life expectancy is shorter. This is the function of that discount rate I showed you on a prior screen. And third of all, if there's two lives, and here I'm showing individuals ages 82 and 80, if they were doing things in their individual names, it would be higher, but to do it collectively, joint life expectancy, the joint life rate is 5.9% because the government assumes they're going to live longer. Nevertheless, their tax-free portion is 87%. Doing your planning, it's, I liken this to be like buying a lifetime bond or a lifetime CD, which gives you a fixed rate and also says to you, when you get your 1099-R at the end of the year, only 13% of it's going to be taxable. Pretty compelling because it makes that rate even more valuable to you. I've got a few more things I want to talk to you about. And I think what you'll do is if you order this from us, order it, meaning just tell us you want to see it, you can see the calculations for a deferred gift annuity in this example. If you're younger than 70, you want to do it for planning in the future. I won't go through the slide except to say to you, if you're thinking about at age 60 or 65 doing a gift annuity, but you don't need the income until you're in your 70s, you can do what is called a flexible deferred gift annuity, and we will calculate for you every year, say beginning at 72, for 15 years hence, every year, what it would be if before the first day came around that you had to make a decision, you made an election for when you want the payments to begin. You would know exactly what they would be, and every year you delay them, you get a higher return. So some people say, okay, I'm 65, I don't want to take it till 72 when I take my RMDs. So let me have a calculation. If I give you money now or stock now, what will I get at 72 or 73 or 74? Count off 15 years. So this slide, I don't have the slide for you for flexible, but I ask you, if you think about it, let us do a calculation for you. Two more quick things to talk about. Charitable remainder trust. We talked about them before. Here's an individual age 75 who has a portfolio of stocks, not IRA money, individual stocks that she had intended to leave to heirs, but they are vulnerable to market. She wants to make them more predictable. She doesn't want to sell them because her capital gain would be $200,000, and who knows what the rate's going to be, particularly in 2022. So she says to her planner, what can I do? And the planner says, put those stocks into a charitable remainder trust. We'll look at the calculation. We'll find out what rate you can get. 5.5 in this example can never be less than 5, for example. Now 5.5 gives her this payment for the rest of her lifetime, gives her a tax deduction, gives her an effective annuity rate that's higher. The question always asked of me is, does this cover inflation? None of the annuities, at least there are some commercial annuities that probably do, none of the annuities that are charitably driven, that give you the security of the charitable gift and the tax-free portions and things of that sort, are going to be dealing with inflation, or for that matter, deflation. Your rate is going to be lifetime rate, but if you did a charitable remainder uni trust, you can cover inflation because you'll fix a rate. Same age person, the rate was 5.5 for the annuity trust. The rate is 7% for uni trust. Why? Because uni trust adjusts every year. So if you create this charitable remainder uni trust, like using your IRA to deal with the stretch provision, and it goes into the charitable remainder uni trust, you can fix the rate at 7, for example, and that would say that at the end of each year of the trust is revalued, and the 7% multiplied by the new value of the trust. So if the trust went up in value, your payment for the next year will be higher. Of course, if it went lower in value at the end of the year, the payment for the next year will be lower in value, but you're betting with a reasonably conservative asset allocation done by trust companies or investment managers like PNC, who does this for American Friends of the Hebrew University, that we'll have some growth in value. You'll get higher payments every year, which will cover the point of inflation. As I say on the bottom here, this strategy can be applied to afterlife contributions of Iras to charitable remainder uni trusts to extend payments to beneficiaries beyond the 10-year rule. These two types of trusts are very useful. And when you're discussing your estate planning with your financial advisor, do mention to him or her whether there is any usefulness in checking out, particularly with IRA, inherited IRAs, a charitable remainder trust. It is not a new phenomenon. It's been done even during the times when there wasn't an elimination of the stretch provision, but now it's being done because of the elimination of the stretch provision. Something to think about as time goes on. So Mara, I'm going to just close by letting people know this is the typical rate chart for AFHU charitable gift annuities based upon ages in the 5s, and the tax-free portion, which is, I think, very important as well. And if anyone is interested in anything we've talked about today, whether it be the tax laws, whether they or not they will change, AFHU is going to be on top of this. You're going to hear from us about changes as they may occur, as we get clearer. We ought to be much clearer. I hate to say this in November than we are now, but November only leaves us 2 months to do some action. But we're going to be clear, and we're going to let you know. And we invite you to contact us for confidential discussions about a gift annuity, about a charitable remainder trust, about your donor advised fund, about capital gains, about step up and basis, about what we see to be the trends, and most importantly, whether there's any feeling there'll be any clawback or any retroactivity. I wish I could say to you this would have been a positive conversation today, that we knew all the answers and we were just waiting for the bill to be signed, but we do not. And had it not been for the House of Representatives, we would still be looking purely at the administration's plans, because there's a lot else going on in the Congress right now, in the government right now, that's made the tax law changes a little quieter than I thought they would be at this stage in 2021. So thanks very much for coming today to the program. I hope it's been valuable for you. I know it's a lot of information. We can help you. I wish you well, and I'm sure your belief in the work of the American Friends of Hebrew University and the importance of the university will be part of your thinking as we close the year. So Mara, I turn it back to you. Mara, I hope you hear me.
Hello, I'm having some difficulty, so you can hear me, not see me, I guess. I just want to thank you, Neal. We're so fortunate to have your help navigating these important year-end changes. I hope that everyone found Neal's presentation helpful. And hello. And we invite you to contact the AFHU staff if you have any questions that were not addressed or would like additional information about tax-wise ways you can support the Hebrew University for today and how to create your personal legacy to support the university for generations to come. I know Neal mentioned we'd be pleased to prepare for you personal calculations at any time. So feel free to contact us directly at info@afhu.org. We can also send you the recording and the slides that were shown today. Every day, and especially during these most difficult times, the life-changing advances at the Hebrew University of Jerusalem are profoundly inspiring us and making an impact globally across so many fields. It is your gifts that ensure the academic and research advancements that continue to help Israelis and people around the world. I'd like to thank PNC Bank again for their wonderful and continued support, to you, Neal, for your insights and guidance, and to all of our guests who are with us today. Thank you for your generosity and being part of the AFHU family. We hope to see you again and in person in the very near future. Thank you.
Bye, everybody.